Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. SPACs are increasingly gaining momentum as a vehicle to bring companies public. Back in 2020, Nasdaq has welcomed a myriad of SPAC listings and business combinations to our market, including a number of companies that have gained financial media attention. And joining me this afternoon to take a deeper dive into SPACs, we have Ryan Maierson. He's a partner with Latham and Watkins, as well as Daniel Harrist. He's a senior associate also with Latham and Watkins. Gentlemen, it's great to have you with us on Trade Talks. Welcome.
Thanks for having us, Joe.
Thanks, Joe.
All right, Dan, I want to start with you first. Tell us what a SPAC is and how does it work?
Yeah, thanks, Jill. I appreciate you having us on. A SPAC is a special purpose acquisition company. It's a shell company formed for the purpose of acquiring an unidentified private operating company. In general, it raises money from public investors. What looks like a typical traditional IPO process. And that IPO is a public offering of units that typically consist of one share of common stock along with a fraction of a warrant generally. The cash that's raised in that offering is placed into a trust account that the SPAC and its sponsors can't touch for the allotted time. And that cash is ultimately what is used, the cash raised from the public is what is used to acquire the operating company. And in the SPAC's IPO prospectus, there'll be a bunch of different disclosure, but one thing that they'll have in there, they'll often include a target sector, kind of what they have in mind, what they want to acquire. But a lot of times, we see it that it'll be a general purpose SPAC where they can acquire whatever they want. But even if there is a specified, target sector, a SPAC can still acquire something in a different sector. So, and we've seen that in a number of different transactions. But in any event, a couple other high points are just that the SPAC's acquisition has to be completed within an allotted amount of time, typically 18 to 24 months. That time period can be extended up to 36 months, and that extension would require a shareholder vote. So it gives the shareholders kind of a say in what goes on with the SPAC. And ultimately, whenever the SPAC finds a target company that it wants to acquire, it will be required to take the proposed acquisition to its shareholders for a vote. And in connection with that vote, whether they vote yes or no on the deal, the shareholders will also will have the right to redeem their shares for cash. So ultimately, they'll have the option to get their cash back if they don't believe in the deal, or if they otherwise want to pull their cash out of the trust.
Ryan, why are they gaining in popularity, and how are they different than a traditional IPO?
So, Jill, a couple of thoughts. One is they certainly have been increasing in popularity. You referred to how many SPAC IPOs there have been in the market this year already. And what we saw is there was about a month during the beginning of the pandemic, late March to late April, where there were no SPAC IPOs. And since then, there have been over 25. Excuse me. And what we've seen in the last couple of months is that the sponsors of the SPACs have been large private equity funds, venture capital firms, really very credible sponsors with significant assets under management. And there's been what I would call a virtuous cycle where you have more credible sponsors doing larger SPAC IPOs and then successfully completing very significant de-SPAC merger transactions, which lends further credibility to the product, because not only do you have a sponsor with a well-established track record raising the cash to go out and hunt for targets, but we're finding that they are actually acquiring significant operating businesses with great success. And so as the credibility and the quality of the sponsors has increased over time, as well as the number of successful de-SPAC transactions, the sector has gotten even more and more momentum.
What are some examples? Oh, I'm sorry. Go ahead, finish your thought.
I was going to just talk a little bit to reinforce one thing Dan said about how they are similar to IPOs, but also a little bit different. One of the main differentiations, and I think one of the reasons they're so popular right now, is not only can you often get a SPAC IPO done at a time where the market may be closed to operating businesses who are having trouble accessing the equity capital markets, but also the price discovery that takes place in a typical IPO is through the roadshow process, discussions with potential investors. And we've seen, in a number of cases, we've seen IPOs of operating businesses trade up significantly in the aftermarket in the first couple of days that the company is public, which may be an indication that the IPO was mispriced in some way. On the other hand, with a SPAC, the IPO price is easy. The value of the shares is equal to the value of the money in trust on the front end. On the back end, when we're setting the value of the business that's going to be acquired in the de-SPAC transaction, there's a price discovery that takes place typically between the SPAC and the target business on one hand, and investors in a private investment in the SPAC alongside the transaction on the other hand. And the discussions with those, what we call pipe investors in connection with a de-SPAC transaction, can often lead to a level of price discovery that is equal to or sometimes more insightful than the price discovery that takes place in a regular way IPO.
What are some examples of SPACs that Latham has worked on in the past, and other areas or sectors that you tend to favor?
We're relatively sector agnostic. Dan and I just completed the successful IPO of a SPAC called East Resources Acquisition Company just a week ago as we're filming this. Within Latham and Watkins right now, consistent with the wave of interest in the space we've seen lately, we have probably 10 or more SPAC IPOs in various stages of confidential submission with the SEC. And as I said, we're a full service law firm, 2,800 lawyers and more than 30 offices around the world. We really don't have a sector focus. In terms of the de-SPAC business combinations, we've been involved in some of the most significant ones. We represented Grosvenor in the de-SPAC transaction that was announced just today, August the 3rd, with Cantor Fitzgerald SPAC. We represented Virgin Galactic in its de-SPAC, Clarivate. We represented Leonard Green in the multi-plan Churchill de-SPAC, $11 billion transaction that was announced just a couple of weeks ago, which is the largest de-SPAC transaction ever announced. So one of the ways we think we differentiate ourselves is that we're the #1 IPO firm in the world, so we can handle the SPAC IPO, but we also have the #1 M&A practice in the world. And so when it comes time to do the de-SPAC, we can serve you from that perspective as well.
Dan, do you think more companies will look towards alternative forms of accessing the capital markets like SPACs versus an IPO?
Yeah, I think definitely. I mean, for anyone following the news, even as Ryan mentioned, there are just some now, even today, every day you check the news, it seems like there's some new interesting SPAC deal being announced, whether a huge SPAC IPO or a huge new initial business combination being announced. And so, company targets, SPACs, sponsors, everyone's finding new and creative ways to structure these deals and get deals done in a really volatile market where, IPOs or other types of traditional deals are pretty difficult. And, I think we would expect this to continue in the volatile markets, with SPACs being a really, really, interesting and important way for companies to get access to capital markets and to ultimately become a public company. But even when things return to normal, SPACs can be can kind of remain a great option for companies. And so it definitely seems like with the momentum that's been gained over the past months and even years, that's something that they can continue to build a track record, and it can be used. And companies and advisors will continue to find creative solutions to meet the needs of these businesses. And right now SPACs are really finding their footing in this, and SPACs are a great example of one of these routes that's got a lot of momentum. And ultimately, that's what we're here for as advisors, is to help these companies find solutions for their businesses to achieve what they want to, and get the capital that they need. And whether that's in the form of a traditional IPO when markets are good for that, or SPACs as we're looking at now, public M&A deals, or direct listings. I know you've spoken with some of our colleagues on direct listings in the past that have gotten increased attention. So definitely, I think companies will continue to be creative as things change around us. But I think there's room for all of them.
Yeah, certainly an interesting spot to be. Dan, Ryan, thanks so much for joining us on Trade Talks.
Thanks, Jill.
All right, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.